Hi, this is Daniel, and you're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. Normally, I like to look at companies from the bottoms up, meaning I'm looking at, does this company have an unrivaled value proposition? How do they compete against their competitors? What are they doing that wins over customers long term? Are they tapping into a big market? These are the types of questions I'm asking myself as I build this case up from the bottom. However, it's also constructive to sometimes consider the top-down perspective. So not bottoms up, top-down, where you're understanding what's going on in the macro picture that could potentially be influencing my portfolio in the years ahead. What could actually drive investor returns in the years ahead? And for considering the macro, I personally look to Ray Dalio. He wrote a wonderful book on big debt crises and how they play out over time throughout history. His mental framework, that construct for understanding how this plays out and how it affects the macro, I think is critical, and I think it's really actually important for growth investors, particularly, investors that were in, let's say, the Cathie Wood ARK funds, because there's a direct correlation that I'm going to talk about in this video between some of the macro trends that Ray Dalio talks about and the returns that ARK shareholders have seen recently, including the drop earlier this year to the rebound recently. And let's talk about that right now. What are sort of the big macro things? What's this most important thing that's, in my opinion, driving the market, particularly for growth assets right now? What's the key variable that's driving everything? And in my opinion, that key element is the elephant in the room, which is the Federal Reserve buying $120 billion worth of securities each month. Here it is. You can see the Federal Reserve balance sheet year to date growing to over $8 trillion, $120 billion a month. This is truly incredible. This moves markets. This is the Federal Reserve buying treasury bonds. And the reason why this is so important is this artificially compresses interest rates, meaning the yields for treasury bonds are artificially lower. So investors around the world who would ordinarily, let's say, get 3 to 4% or maybe 5% in treasury bonds are now only getting 1 to 2% because of this artificial buying that's going from the Federal Reserve. The Federal Reserve creates money to buy these securities and they hold it onto their balance sheet until, in theory, they reverse that in the future. And so this, by lowering the returns that you can get from owning treasury bonds, the thought process is, oh, the Federal Reserve is somehow supporting the economy by raising asset prices. And it does flow down to a lot of other different asset prices, as you'll see in 1 second, which is that here it is with US junk bonds. Just last week, Centene sold $1.8 billion of junk bonds with a record low coupon, paying effectively 2.45%. The average junk bond currently yields less than 4%. Now, folks, does this make any sense when you think about it? Junk bonds means you're just shy of being effectively in insolvency territory or in a state where you can't pay these bonds. You are so levered up. This is a problematic state to be in. And here it is. Inflation itself is currently running around 4 or 5% plus, and the yield you're getting for these bonds is around 3-4%. This makes no sense whatsoever. You're not getting any sort of additional income for that risk. And that's an indirect byproduct of this Federal Reserve stimulus, where the Federal Reserve is buying $120 billion worth of securities, mostly treasuries, in addition to some mortgage-backed securities. And so this has huge secondary effects, because not only does it artificially pump up the prices of treasuries, it artificially pumps up the price of junk bonds. And then junk investors go, well, wait a second, I'm no longer getting my return in junk. So then they say, well, maybe I'll get a dividend yield. So then they move to stocks. And so then stocks get artificially bid up. This is what's been going on for several years now, but particularly with QE sort of really juicing things up to the tune of $120 billion a month. And here's where it's directly tied and directly proportional, or I'd say there's a strong correlation to what you're seeing with growth stocks. And just recently, this last week, articles coming out, hey, the ARK funds can breathe a sigh of relief as, Cathie Wood mounts a comeback. Her main fund, looking at ARKK, now has erased its 2021 loss. It's brought in some capital. But what you need to understand is that since the Federal Reserve meeting just a few weeks ago, ARK popped about 10%, while the 10 and 20 and 30-year bond yields dropped, i.e. these bonds got bid up. And this is the exact inverse of what happened prior to that meeting, as investors were saying, well, wait a second, isn't the Federal Reserve going to have to cut this quantitative easing each month, and rates start going up? When rates start going up, that means the bond prices are going down. And if rates start going up, then the value of these really long duration securities like unprofitable growth stocks, when you value an unprofitable growth stock, you're saying, I'm valuing this based on the cash it's going to generate years and years from now. So the higher the interest rate you have, the value of that stock drops disproportionately, because you're discounting future years out at an even higher rate. And so this, you can see it pretty almost with a 1-to-1 correlation with the ARK funds, where ARK dropped significantly as long-dated U.S. Treasuries started ticking up. The interest rates, went from like 1% to like 1.5%. Ordinarily, in a grand scheme of things, 0.5% doesn't sound that much, but when it's a move from 1 to 1.5, that's actually a much bigger move. And so here it is, the ARK fund lost about, across their different ETF products, lost somewhere between 30 and 40%. Then it started recovering when the Federal Reserve was like, don't worry, quantitative easing, we're not in a rush to remove it. And so then it's like, oh, okay, we can buy back, the yields on these bonds went back lower, and so did and the ARK fund, which you'd think is like the inverse of what's going on with these yields. The ARK funds got a bid higher. And so that creates a big question of like, well, what happens ultimately when quantitative easing stops? And we'll talk about that in just a second, where what happens? What happens when the Federal Reserve says, hey, we're no longer going to spend $120 billion a month to buy Treasury securities to sort of prop up the market? What happens when this stops? And this is where it creates real challenges, because if you look at, so here's the Center for the Center Budget Office for the United States, you can see what their deficit has been and is projected to be in the years ahead. 2020 was obviously a big deficit year because of a lot of stimulus and reacting to COVID, of $3 trillion deficit. Now that's versus a U.S. economy of $20 trillion. So you're talking about 15% deficit spending. In 2021, we're looking at closer to 10%. But here's where the real problem happens, is that every year pretty much going out for this next decade, the deficit, now this is the rosy figures from the CBO, effectively saying, hey, we're going to have a deficit of 5% of GDP. And this is actually really important. And this is another key aspect that I learned from understanding the Ray Dalio's framework, which is that you can't just say overnight, oh, we're just going to cut the deficit, like, oh, this 5%, this won't be a problem. We'll just cut spending, because the government spending is another person's income. And that person's income is, let's say, maybe mortgaged, is supporting a mortgage or supporting some levered assets. And so if they lose their income, all of a sudden the banking system also takes a hit, because, hey, this typically solvent borrower now is going to have a hard time paying it back. So if you have some sort of mission to say, hey, we're just going to cut expenses, that doesn't work. That actually tends to make the problem worse in this scenario of saying, hey, the government's just going to cut it, and 5% of the economy disappears. So you can't just do that. And it creates real problems, because if the Federal Reserve says, hey, right now, if we have this huge deficit spending of, let's say, $2 trillion, well, the Federal Reserve is saying, hey, each month we're buying $120 billion with money we just created. So the Federal Reserve is effectively buying the debt spending from the Treasury. So these deficits from the Treasury, the Federal Reserve is monetizing by buying it. Now, if the Federal Reserve doesn't step up and says, oh yeah, we're going to stop quantitative easing because COVID's over, time for the economy to find a natural supply demand, well, now you're going to start having the problem that you see in this chart, which is now the marketplace is going to have to find $1 trillion deficit that needs to get financed each year. And so the question is, what does the supply demand aspect look like if the US government has to finance over $1 trillion a year in the years ahead. Does that mean much higher interest rates? And the reason why that is so critical is, as I just said, interest rates drive long duration securities like stocks, and particularly these growth stocks that are unprofitable right now. And the reason why the ARK fund did so well is because interest rates went down a little bit, saying, hey, QE is going to last longer than expected. That might be a short side move. It depends on how long QE goes for. A lot depends on the leadership of the Federal Reserve. And so you're looking at this thinking, oh man, if there's a new equilibrium where, let's say, rates are 3, 4, 5% in the future, that would translate to a reset in these growth assets, a reset with a much lower valuation, I'd argue. So that's something that I'd argue all ARK, all growth, all innovative investors are considering right now, is that even if you don't know you're doing it, you're implicitly betting that rates stay low with a lot of these growth stocks, because there will be or could be a dramatic reset just based on this supply-demand dynamic that I just mentioned. $1 trillion a year that the Federal Reserve, if they're not buying it, then we're going to have to find others to buy it. And the question is, who's going to want to buy this $1 trillion a year? And so, and this is where it gets really challenging, is the US inflation rate is now 5%, arguably maybe even more. So who would want to buy bonds yielding 2 to 3%, junk bonds at 3 to 4%, when you effectively know you're going to lose money? So this creates a real problem, because now these bonds, in a true supply-demand rebalancing, would have to earn a much higher yield, in which case that valuation for those growth stocks take an even harder hit. And so this is the really tricky paradox that we're in right now for investors. And so what happens? Ultimately, an adjustment happens. It's typical, supply demand aspect, where, hey, if you have a supply of $1 trillion bonds that you're going to have to issue to finance US deficits, and the demand's not here, well, you got to make it more appealing so the demand starts showing up. The way to make it more appealing, because you have this minimum $1 trillion in deficits that you're going to need to finance, in order to make this more appealing, what you're going to need to do is make it higher rates. So higher interest rates. So you actually let the marketplace set, hey, what's the appropriate rate to get paid for this, versus the Federal Reserve artificially suppressing interest rates. So in that scenario, yeah, you do get higher rates. Now, how can you position yourself for this? How do you adjust to these adjustments of potentially higher yields? And I've previously talked about Dr. Michael Burry, who's one of the most exceptional investors out there, how he's personally positioning his portfolio based on the first quarter 21 filings, which is interesting, where 3 of his largest positions are effectively betting on this trend. So regardless of what your take is on Tesla, which he's obviously betting against, and I've talked about that before, how I'm in line with that view that Tesla stock has a very expensive valuation. 3 of his largest positions effectively are in line with this macro trend, which is, hey, there are 2 bets going against US Treasuries, effectively saying interest rates go higher, and 1 that growth stocks will take a hit. I mean, that's in addition to the piece that he effectively tweeted earlier, when the ARK funds were much higher, saying, hey, this could take a hit because of liquidity concerns. But I'm looking at three of his, let's say, top 10 positions reflect this broader macro concern. And you can see it with the price dynamics as well, what's been going on with US Treasuries. Even though it recently did get a bid, it still has been, US Treasury bonds the price of the bonds have been falling, the rates have been ticking up higher. So what should investors do in this scenario when you consider this sort of tricky, sort of knife's edge that you're considering, where, hey, if the Federal Reserve, keeps printing away, then hey, you can have this melt up. But if they actually start scaling back, rates go higher and things get all mixed up. So first, a quick plug. If you enjoy learning both about the macro as well as bottoms up analysis on individual stocks, typically I'm looking for potential multi-baggers. Please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. If you want to follow my personal journey, first week of the month, I call out my full portfolio, top holdings, why, and what I hold. And then during the month, I also call out at least one potential multi-bagger or stock that I think has that potential upside long term, potentially hundreds or even thousands % upside. There's also a dedicated an exclusive community, a Discord community at unrivaledinvesting.com. But let's go back to this in terms of understanding what should investors do. And the first thing that I think investors should consider with a great reset is to think about the risk reward with each of your positions. Unfortunately, I see a lot of folks these days sort of saying, hey, I own some things that have done really well over time. Maybe Tesla's your biggest position. Maybe you own something where it's like, hey, it's worked really well. You need to understand that three things drive stocks over time, one of which is valuation change. And the reality is valuation change over a multi-decade period drives effectively zero of your return. And so the big concern right now is a lot of folks are mistaking this change in valuation, this valuation benefit, that they've indirectly benefited from this Federal Reserve artificially suppressing rates, which causes valuations to expand. So my concern is a lot of folks are saying, hey, it doesn't matter. Valuation doesn't matter. And I've seen that. And that is a highly problematic take, because what can happen is you can say valuation doesn't matter, and then you can sit on something for a decade, 2 decades, 3 decades. And that's literally happened with the Japanese market from the 1980s, where investors there had a terrible ride and returns went nowhere for decades. Not an exaggeration. Valuation 100% does matter. If you're seeing something where someone's not calling out the valuation, that's a big red flag. I would want to learn more about that. So for me personally, when I'm looking at my personal portfolio, I'll want to own these incredible companies that I think have incredible runways in front of them. Maybe they're unrivaled companies, but every single one of them, I want to think about what's that valuation. And I will position my portfolio. This is where portfolio management comes in. I will position my portfolio weightings based on what I think is the best risk reward that I consider. So I might own something where it's like, yeah, I still think that's huge upside, but there's also this huge potential downside risk. Yeah, there's potentially room in your portfolio for that. I'm not arguing against that. But from a what should get the biggest positions, those are the positions that my biggest positions are usually things where I'm like, oh, okay, the downside when I'm looking at this, I think is very manageable. Maybe I still make money on the downside. Maybe I make 50% on the downside. And the upside, I can make a couple of 100% over, let's say, the next 3 to 5 years. So that's the key aspect. One of the first key aspects to consider as we potentially face an environment over the next few years with higher interest rates and a reset lower with growth stock valuation, which could have a huge impact on, let's say, the ARK fund. So what's the next variable that you need to consider? So not only do you need to consider risk reward, in my opinion, you should also consider your own liquidity. And so what that means is there's a lot of folks that are effectively like, hey, I'm all in the market right now 100%, or maybe 130%, 120%, 150%, where they're borrowing money to own stocks. And that is an inherently fragile position to be in. Ultimately in life, you want to be able to take advantage of whatever stressors come your way, as Nassim Taleb, coined the term anti-fragile. And so that's what you want to focus on. And so if you don't have that liquidity to, let's say, capitalize on future stressors, that is a tougher position to be in. So I would say, obviously this depends on your own personal journey, but you need to think about, well, wait a second, what if bad things happen, a 20% drop, 30% drop happen. So mentally having that preparedness to consider as you think about it. Also, the similarity of there's a lot of folks that are getting into the market for the first time and they're not realizing, wait a second, what if I have an unexpected expense? That's also something where it's like, it would be beneficial to have some cash set aside. So that way you don't have to, let's say, sell a stock at an inopportune moment because you need to pay for an unexpected bill. So I'd say you need to size up your own personal liquidity. Maybe that has to deal with taxes, maybe it's bills, or maybe it's just how you want to sleep at night and being prepared for any future stress. I'm not saying, keep in mind, I'm not saying, hey, this is going to happen, today, tomorrow. Right now, we're in an environment where, based on the current signals, the Federal Reserve is spending $120 billion a month with money that was just created to buy securities. That is a big green light for a lot of risk on securities. So that's the reason why you're seeing, the ARK funds get this bid. So I'm not saying, hey, watch out. This is not supposed to be a doom and gloom video. This is trying to take a realistic, no hype view on things that you might want to consider. So then the third component that I'd say in terms of what should investors do as they consider this potential risk adjustment is you have to figure out what's right for your own journey, like how you ultimately want to live, how you want to sleep at night. I personally have an approach where I consider using hedging based on effectively pricing dynamics, where I will hedge my portfolio. I long term, I don't want to hedge. I think the best hedging is probably just owning great companies at reasonable prices. But if the market is extremely frothy, maybe it's worthwhile to consider a hedging strategy for the near term. And so that's my own personal approach. Other people can say, you know what, I always want to sit on 20% cash. I always want to sit on 50% cash. I know some investors that are like that, where they're like, I don't mind if I miss out on these returns because long term I know this 50% cash could be worth a lot if there's a great reset. So those are the different things to consider. Now keep in mind that 50% cash position, that's also a really tough position to be in, because that investor knows that 50% effectively is losing its value to the tune of whatever inflation is. So if inflation's 5%, they're effectively losing 5% of the value of that 50% a year. So that means the portfolio declines by 2.5% in purchasing power in that year. So these are the different things that only you can answer on your own financial journey. But these I think are the three components that one should consider, which is, what is the risk reward that I'm implicitly, baking into to my investments based on their current price? What's my own personal liquidity, in terms of how much cash do I have? And then also, what's my own personal journey? Do I want to be hyper aggressive at all times? Do I want to have some sort of dynamic hedging approach? Do I just want to have some extra cash buffer? So I hope this video talking about Ray Dalio's framework has been helpful for you in terms of understanding what are sort of the macro forces, the top-down forces that will likely be driving investment returns in the years ahead. Now, ultimately, I focus on the bottoms up because I want to find these things that will be growing regardless of the macro. That's what my goal is in finding these potential multi-baggers. And for example, one Journey subscriber earlier today was like, Daniel, how come you're calling out some of these healthcare stocks as potential multi-baggers, or why are you buying some of these healthcare stocks for your own personal portfolio? Well, if I find, let's say, a healthcare company that I think is disruptive and can potentially grow at an attractive rate, let's say trades at half the valuation of a favorite meme stock like Clover, has faster growth, bigger, better profit margins. Yeah, that's what I'm going to be interested in. Plus, I know that healthcare is generally less cyclical. So that's a key element I'm thinking about when I'm considering this macro environment of, let's say, higher interest rates, which could lead to a reset in the economy as well. Oh, okay, healthcare is probably not going to get hit that bad, versus, let's say, some of these other highly cyclical, discretionary driven consumable stocks. So those are the types of things that I would consider. If this video has been helpful for you, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. Thanks so much for watching.